folks, this is an emergency message. If you are a stock market holder, investor, trader, market participant, hell, even conscientious observer, you need to be watching this video. Markets are chaotic, emotions are high, and when emotions are high, people make big rash decisions that they end up regretting massively. And whenever the masses are making decisions based on emotions instead of real data and evidence, well, that's when the biggest opportunities come for folks that are actually paying attention to said data. It's incredibly important to be calm and strategic right now, because right now is going to be the period of time that sets you up for rapid growth over the next 6 to 12 months. In today's video, we're going to break down the following. Number 1, why markets are going down. Number 2, bubble concerns. Number 3, Federal Reserve concerns. How is the market being guided down by the Fed right now? And number 4, and most importantly, really, what is a clear, concrete, and reasonable strategy to be able to use this time to come out on top in the long run? How can we both protect ourselves and come out ahead? And the only thing I ask in return for all of the work that goes into making a video like this is that you hit that like button, and also don't forget to subscribe. And if you can, share this video with a few friends on X or Facebook or Reddit or wherever they are, because I think this is a message that a lot of people are going to need to hear. And as always, of course, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Also, quick plug, our Black Friday sale has officially started. Get $100 off our annual membership when using that first link down below. Discord members get access to all of our ideas and alerts, our stock briefings, which include daily chart and setup analyses, daily morning briefings, our price target forecast sheets, our model portfolios, our urgent news and catalyst AI bots, and our 10+ hour video lesson library. In today's volatile condition, it's very important to have a philosophy and evidence-backed service to really keep you grounded. And that's been the whole goal of ZipTrader's Discord since the beginning. Okay, so the market is continuing to dump. The fear and greed index has just fallen to 8, now at its lowest level since the April 2025 bottom. And a lot of people are feeling that this dump is even more painful than April 2025, because a lot of the high-flying tech AI names are getting beat down a lot faster than they were back then. And if you look at hedging, people are now hedging their downside right to a new breakout level. Now, of course, the last couple of weeks have been chop November, very choppy November after a beautiful October, and many folks were hoping that Nvidia's earnings release would bail out markets, and they did release a beat on earnings. And it did bail out markets for a few hours, but then all of a sudden, a few hours into open, what happened? Well, boom, Nvidia got beat down and the overall markets got beat down. In fact, Nvidia stock went up about $450 billion to minus $450 billion in no time at all. Talk about a whipsaw and a neck breaker. For scale, I mean, Palantir's market cap is just under $400 billion. So Nvidia today alone gained and lost an entire Palantir valuation. So what exactly is this telling markets? When markets see a massive, insane beat like nobody's ever beat before, and the stock still goes down and flips this much in a session, what does that tell markets? Well, it tells markets that it doesn't matter what your company does. It's going to be beat down, because that's the condition we're in right now. In terms of sentiment, obviously this was a big punch in the throat for folks that wanted a quick bounce. Only time will tell, but sentiment is starting to dwindle, and that is something to take note of, because that might mean we're going to get better opportunities soon. Here on this channel, we're always cautious bulls, which means we understand there's going to be dips, there's going to be corrections, there's going to be crashes, but long-term, well-run companies that are creating real value in the economy are going to shine through. Plus, your mindset today is going to dictate how you do over the coming weeks and months and over the coming years. So anyways, what we have right now, is it a breathing cycle? Is it a correction? Is it going to be a massive bubble popping market crash? Well, as always, context is key, and we have simply not even allowed the market to think about breathing for quarters now, and that's very unusual historically. And so as a result, we are currently seeing the worst November trading in 17 years. If you look at market history, we usually see a sell-off in September, and sometimes we see it later into October, and sometimes you get it a little bit earlier, you get it in August. But this year we actually skipped August sell-off, September sell-off, and October sell-off. And so now we're getting a November sell-off. So just from a historical standpoint, I mean, right now, breathing is normal. Sell-offs are normal, and they're a very important part of routine trading. If markets do not get regular sell-offs and tests, well, they'll melt up really fast, and then the inevitable crash that comes is going to be about 5 times worse. Some of those crashes can be so severe that the entire financial system collapses, which is why nobody wants that to happen. It's better to have regular corrections, regular dips, than to have something that just melts up for a very long time, makes everything everybody happy and rich, and then all of a sudden blows everybody up. So we love to see testing, not only because it helps the market breathe and sustain its overall bull trend, but also because it allows good entry prices. The next aspect I want to talk about are bubble concerns. Now, for much of this year, and especially since the markets have been going down this month, well, every time I open up X, Reddit, financial media, whatever it is, well, I'll endlessly be presented with this circular financing chart, and bears will say that this chart is undeniable, unrefutable evidence that AI is a massive bubble and can't sustain itself. They say anyone who buys even the most profitable tech companies today will see similar results as if they had bought pre-sales online pet poop companies in the dot-com bubble days. They'll say it doesn't matter how much money these companies make, they're massive scam bubbles. The proof, this chart. Bears say this chart proves without a doubt that the AI build-out is nothing more than a self-sustaining Ponzi scheme. And of course, as markets have gone down and the AI bubble names, so to speak, have been hammered, well, people say, look, these bears are being reaffirmed again and again in this analysis. And this is causing a lot of folks to abandon their convictions and is going to cause a lot of them to avoid buying any kind of dips, even in some of the most profitable companies ever. So look, I just want to give you a very, very simple analogy here and something to think about if you're somebody who keeps getting blasted with this chart and you keep being told that you're an idiot if you buy any kind of stock on a dip. Imagine a city growing at a once-in-a-generation pace. People keep moving in, housing demand is exploding, jobs appear faster than workers, and builders can't keep up. Let's just walk through the chart. So you start with new tenant demand. More people demand housing. People flood into this new city for jobs, lifestyle, opportunity. Housing fills up, wait lists form, prices rise. This can be compared to AI demand. Enterprises, startups, governments, model builders, and apps all wanting more compute. Real usage equals what? Real demand. And then what happens? Well, developers borrow to build apartments. Developers see the demand and borrow to build new places to live. Banks are happy. Banks and partners are happy to lend money because they see all of the demand. And so none of these people are gambling. They're responding to a line of tenants who already exist and a huge proof of concept in terms of said demand. This is like cloud providers, Microsoft, Oracle, CoreWeave, raising capital to build new data centers and buy GPUs. Demand is actually preceding. It's preceding the new borrowing. Of course, you get the approvals. Banks and partners finance the developers. They give them the money. Banks, lenders, and capital partners look at the situation. They look at the full buildings, the growing rents, overflowing tenant wait lists. Again, all proof of concept. And so what do? They confidently provide said financing. This is like venture capital, sovereign funds, and enterprises funding AI infrastructure, lab, and model training. They aren't propping up demand in a falsified way. No, they're funding growth of infrastructure because the demand is undeniable. So they know it's a home run if they fund this growth. What happens next? Well, developers order materials and hire labor. Developers order lumber, steel, concrete. They hire architects and engineers. They hire contractors and crews. They schedule equipment and logistics. And this is the stage where the build out becomes real. In AI terms, this is cloud companies and model labs placing massive GPU orders and hiring AI talent, all things that we've seen this year. And then the next one, materials companies get orders. Material companies ramp up production, and they might need lending too in order to build out their overall apparatus to catch up with demand. As labor companies pour in the orders, while material suppliers are going to expand their lumber mills to add shifts, concrete plants are going to increase output, steel plants are going to invest more in capacity, hardware stores, logistics hubs, and suppliers are all going to need to scale up. NVIDIA is doing this in the same way. They hire TSMC to manufacture the chips. They're hiring memory suppliers, networking vendors, substrate manufacturers, cooling plus power infrastructure providers. NVIDIA is ramping all these up in the same way that material companies are ramping things up when they get massive orders. But the key with this step is understanding that these material orders, they're real and they're paid for. It's not Fugazi Ponzi. That's what people want you to think. But just like when you're building a city, these materials are bought and paid for. Next, construction companies build apartments. And of course, the people that move into these apartments also want stores, schools, parks, other businesses, hospitals, so on and so forth. This is like companies building out model training, inference, apps, platforms, and entire digital industries. They aren't inflating demand by building out these industries. They're responding to overflowing demand for compute. And they're also responding to more compute being available. Hey, all of a sudden we have all this new infrastructure. Why don't we build some apps on it? Next, the city is improved by all this. After construction, the city becomes more livable, more functional, more connected, more valuable overall. More parks, more schools, more stores, more infrastructure. The city as a whole becomes a lot stronger. And this is what happens when AI infrastructure improves. There are better models, faster inference, more capable products, new services being built on top, compounding innovation loops. Better AI ecosystem means more demand, more workloads, more compute and more GPUs. And a better city means what? Well, it means more people are going to want to move to it. So then you have more people demanding housing. And then what happens? Well, the whole cycle continues again. That's the overall economy that we're in right now when it comes to the AI space. A better AI ecosystem attracts more customers, which attracts more companies, which attracts more customers, which attracts more companies, which requires more hardware, which improves the ecosystem further. And it just keeps going around and around and around. Every step in this new growing city is driven by real tenants, real demand, real construction, and real economic output, not speculative BS Ponzi leverage. Everyone is building because demand already existed in the first place, and demand is growing because people are building more and things are getting better and better, which attracts more people. And if different partners want to contract with each other to make the process go faster, well, that is not evidence of a bubble. It's evidence that things are growing fast. A healthy expansion cycle is where you have real residents, real businesses, real rent revenue, real economic activity that justifies the upstream circular expansion. That's exactly the same as like real AI workloads, real enterprise adoption, real cloud spending, real model usage, and real revenue, which is justifying the GPU purchases and overall infrastructure investment in this AI boom. Now, again, I understand bears would look at this chart and they'd say, yeah, I listened to everything you said, but it's a circle and circles sound scary. Circles sound like bubble. If all of these players would simply not work together and would instead work separately, we wouldn't consider it a bubble. What? That makes no sense. At the end of the day, if you're going to go back to the housing analogy, I mean, a bubble is when you build empty buildings hoping someone someday will move in, and then it pops when no one does. Today's AI world is building apartments that are fully leased before construction even finishes. There is way more demand for apartments than there are even apartments being built currently. So when somebody says, you know, this is a big bubble and I have the proof and that's because of circular financing or that's because prices have gone up too fast, well, again, you need to look at what the money is doing, what it's building out, and what the eventual end result is going to be. And the end result is going to be better models, better AI products, which is going to result in more demand, which is going to result in more investment, which is going to result in better models, better products, and more demand. And that's going to be a circle that's going to allow the overall AI wave to really, really create a lot of wealth. That doesn't mean things are going to go straight up. Of course they won't. But it does mean long-term potential for those who don't have their eyes closed and are just headline jockeying around. Okay, let's talk about the Fed. So one of the biggest things that shocks new investors in the market is the sheer amount of power that the Federal Reserve has over stock market valuations and overall trading. You could have the best companies in the world printing the best amounts of money, but if the Fed says we're going to skip one cut, a lot of people are going to capitulate. From the New York Times, quote, many officials at the Federal Reserve did not think the central bank should lower interest rates in December when they voted last month for a second cut in a row, according to minutes from October's meeting. Why is this? Well, quote, most participants noted that against a backdrop of elevated inflation readings and a very gradual cooling of labor market conditions, further policy rate reductions could add to the risk of higher inflation becoming entrenched or could be misinterpreted as implying a lack of policymaker commitment to the 2% inflation objective. So the Fed has two mandates: make the rich richer and the poor poorer. Oh wait, sorry, Freudian slip. The two mandates are support price stability and support employment. In order to support employment, it can cut rates. In order to support price stability, it can raise rates. Unfortunately, the measures that they use tends to be based on Fugazi math, on a Fugazi currency, which means that in effect, the dollar erodes faster than the inflation rate suggests, and employment is worse than the employment data suggests. However, these are the two effective mandates that the Fed has. But bigger picture, if you understand where the Fed is going, you have to understand not to fight said Fed. And since the December rate cut was already priced in, people thought it was a go. Well, now that it's increasingly likely to be skipped, a lot of people are trying to sell to pre-factor in that risk. But bigger picture, this is an arbitrage opportunity. Why? Well, because the short-term Fed goal right now is probably that we're not going to get a December cut. So sure, markets go down. But the medium-term Fed goal, and almost all of the Fed chair folks are in agreement with more or less, is that over the next 6 to 18 months, they're going to cut rates. Which means what? Well, if you're actually looking at the medium term, you actually are in a period of cutting. You're not in a period of prolonged pausing. And just because they skipped one meeting doesn't mean that we're going to continue to see rate cuts be paused. And considering that we're in a midterm election year and Trump's going to be able to choose a new Fed chairperson in May, well, it's hard to imagine that we don't end at much lower rates by the end of next year. So as the Fed teases that they're going to skip this December cut, a lot of folks are going to capitulate. A lot of that's going to be algorithmic trading that just buys and sells sells based on Fed signals. But if you can understand that, you can understand that long term, this is another thing that's going to create an arbitrage opportunity. Okay, great, Charlie. So what do we actually do to protect ourselves and set ourselves up to win? Well, accept the facts. The bigger picture here is that yes, we are in a powerful AI-driven bull market. Yes, there will be regular corrections and an eventual nasty drawdown that will make you come running home to mama and papa. No, you can't predict which sell-offs will be the big one. No, you shouldn't abandon your goals, your plans, or your entire portfolios every time the media says a bubble has popped. This is just fear-mongering BS, and a lot of it is funded by short sellers, or at least our short seller-armed media, where they literally have an incentive for you to sell. Instead of asking, is the AI bubble going to pop tomorrow? Ask, am I mentally, emotionally, and positionally prepared for when a crash does happen? Because again, while we are incredibly bullish long-term, it's important to note that throughout history, we've always had corrections and dumps, and every dip brings with it the possibility, but a lot of people are just never prepared to actually take advantage of it. So how do you actually prepare yourself? Well, start with focusing only on high conviction stocks that you believe in, rain or shine. These stocks must have long-term proof of concept, a competitive moat, leadership in their space, are in a booming industry, have a lot of long-term upside to realize. Number two, accept that cycles are messy. Not every drop is a bubble popping, and not every dip bought will go straight back up. That is fine. That is acceptable. Expect the unexpected. When everyone expects stocks to go up or down, it's very possible the opposite will happen. Be aware of that. Number three, build emotional control. This gets so many people. They obsess over their positions, and they question themselves every minute by minute. Limit app and news checking, portfolio obsessing. If you have long-term ideas, you don't need to check them all the time. Short-term ideas can be managed with stop losses. Treat your portfolio like a business. Keep a journal of your mistakes, your plans, and your overall goals, and stick the hell to them. Design a plan that you would be willing to execute, rain or shine. Number four, keep enough cash on the sidelines. Keep 10 to 20% in cash / ultra safe assets like T-bills as dry powder and protection. This is kind of like a crash shield portion of your portfolio that's built to survive anything. Buy a high conviction dip slowly and over time. Always invest a set amount every month, rain or shine. Only deploy extra firepower when markets or conviction stocks are 20% plus off recent highs. Slow down contribution when markets are euphoric and extended. Anyways, folks, that's it for today. Enjoy the roller coaster, keep the bigger picture in mind, and make decisions that you're going to be proud of in 1, 2, 3, 5 years from now. And of course, make sure to take advantage of that $100 off coupon code for the annual membership on the ZipTrader Discord. We'll see you in there.